This is an analysis from Alpha Business Media. Today, we're diving into a really high-yield investment opportunity, one that sits right at the intersection of agriculture, technology, and logistics in Nepal. It's a story about solving one of the country's most persistent and, frankly, most frustrating economic problems.
This single sentence, it just gets right to the heart of the issue. You see, for decades, when we've seen produce rotting in the fields, the blame has been misplaced. The real problem isn't about how we grow things, it's about how we get what we grow to the market. And the scale of this failure, it's absolutely staggering. Just look at this number, 30 to 40%. That's the estimated amount of high-value produce in Nepal that's lost after it's been harvested. Now, this isn't just waste. It's a massive economic hemorrhage, draining value directly from the pockets of smallholder farmers and, really, from the entire national economy. To put a human face on that percentage, I want you to picture a tomato farmer in Dading. He's standing over crates of these perfect, ripe tomatoes, but the truck is late. By the time it finally arrives, a third of his harvest and his profit has literally spoiled under the sun. This exact scene plays out every single day, all across the country. For years, the proposed solution has always been the same: just build more cold storage. But the model itself was fundamentally wrong. The focus was on these massive, multi-core facilities located near big cities, which is miles away from the farms that needed them the most. So why did this seemingly logical solution fail so spectacularly? Well, it all came down to a fundamental misunderstanding of the user. These facilities, they were built for large exporters, not for small-town rural farmers. They were too far away, they were way too expensive, and they forced farmers into crippling debt for an asset they might only use for a few months a year. It was a solution designed in a boardroom, not out in a field. And this brings us to the real solution. The opportunity here isn't just a better building. It's a completely different business model. It's defined by a really powerful economic shift, moving from capital expenditure to operational expenditure. Okay, so to really get this, we need to be crystal clear on these two terms. CapEx, capital expenditure, that's a huge one-time investment to buy an asset. Think a 2.5 million rupee cold room. On the other hand, you've got OpEx, operational expenditure. That's a small, recurring, pay-as-you-go cost to use a service, like paying, say, 70 rupees to store just one crate of your produce. This contrast right here really shows the genius of the new model. Under the old CapEx system, all the risk is on the farmer, and that expensive asset can easily become a liability. But the OpEx model, what we're going to call cold chain as a service, or CCaaS, it completely flips this. The operator owns the asset and takes the risk. The farmer just pays a small, flexible fee which perfectly aligns the cost with their seasonal cash flow. And this analogy just brilliantly illustrates the change in mindset. The cold chain stops being this terrifying multi-lakh investment and instead becomes a simple, on-demand utility. That massive financial barrier to entry, it's completely obliterated. A farmer can now buy preservation and market access just as easily as they buy mobile credit. So how does this new model actually play out financially for an individual farmer? To really see the impact, we need to zoom in and look at the unit economics of a single crate of produce, which in this model becomes a really powerful financial instrument. I mean, this is the key question, right? The theory is great, but does it actually generate more income for the very people it's designed to serve? Let's analyze a real-world case study of an apple farmer from Jumla and just see what the numbers tell us. All right, let's follow the money. In scenario A, without any cold chain, the farmer is forced to sell immediately, right when the market is flooded with apples. He gets 80 rupees per kilo for a total of 40,000 rupees. Now look at scenario B. He uses the CCS unit. He pays 6,250 rupees to store his apples for just 5 days. This waiting period lets him find a better buyer, one who pays 120 rupees per kilo. His total revenue jumps to 60,000, and after you subtract that storage cost, his net revenue is 53,750. And that all leads to this: a 34% increase in the farmer's net income from a single harvest. You see, that 6,250 rupee fee wasn't a cost. It was an investment that yielded a phenomenal direct return. This is the power of using simple temperature control to create pricing power where none existed before. But, and this is so important, To view this opportunity as just selling refrigerated boxes is to miss the multi-billion-dollar point. The hardware, that's just the beginning. The true, scalable investment is built on the invisible layers of software and data that sit right on top. This is the core investment thesis right here. The cold unit, yeah, it solves the spoilage problem, but the data platform solves the much bigger problems of market access, of trust, and of finance. The most successful companies in this space won't be hardware manufacturers. They're going to be tech companies that operate a massive logistics network. So this network, it creates value in 4 distinct layers. It starts with an aggregation and booking platform to make sure those cold units are always being used. From there, it becomes a virtual marketplace, connecting farmers directly to large, reliable buyers. Next, you add traceability with things like QR codes to build that essential trust. And finally, all this data creates credit scores, which unlocks fintech loans and solves the chronic lack of capital in farming. So, what does the future hold for this sector? Well, the path forward isn't guaranteed. Success really depends on the strategic choices that investors and operators are making right now. So let's look at the 2 potential outcomes, the bull and the bear scenarios. Okay, the bull scenario. That's where operators focus on tech, on service, and on creating a powerful network. They unlock bank credit with digital receipts, creating a whole new high-return asset class. Then you have the bear scenario. This is the hardware trap. The market gets flooded with cheap, inefficient units sold directly to farmers without any service layer. They break down, the costs are too high, and the entire sector just gets a reputation for failure. And this brings us to the hard truth of it all. The winner here won't be the company with the slickest app. It's going to be the company that masters the immense operational complexity of rural Nepal. I'm talking about managing trucks on unreliable roads and convincing skeptical farmers to trust them with their entire livelihood. And we'll just end on this thought. The opportunity is absolutely immense, but it's an investment in a meticulously executed logistics and human services company that just happens to use refrigeration. Because in the end, technology, well, that's just the tool. The platform it's all built on has to be trust.